Hey everybody, it's Hutch with bankingtruths.com, and I just wanted to give you a quick and timely update on this market crash and what that could mean for infinite banking. Now, the smartass answer to why are markets going down, you can see this massive dip overnight, is more people are buying this, or more people are selling than buying. And although that's true, it's like, why are they selling and who is selling? It's not just mom and pop investors and their 401ks. It's not Robinhood meme traders. We're talking about big institutional investors. That's who moves the market. And probably the biggest institutional, well-known investor is Warren Buffett. And it came to light last week that Warren had sold a lot of stocks, a lot of Bank of America, but sold half of his Apple position, which was the biggest holding in his whole portfolio. And Warren's known for amassing massive cash piles when he thinks that asset values are just too high, too bubbly. As you can see here, Berkshire Hathaway's massive pile of highly liquid assets is back to its highs from just before the financial crisis of 2008, of course, where he did quite well from having so much cash on hand, was able to buy things on sale, was able to bail out Goldman Sachs, make some shrewd moves, and make a tidy profit for himself, as well as all Berkshire Hathaway investors. So the other kind of hidden reason, obviously there's geopolitical unrest, we may be going to war, but the other hidden reason is something called the yen carry trade. And if I just put explain the yen carry trade into Google, you can see here in the yen carry trade, investors borrow and sell Japanese government bonds they don't own. The cost is small because Japanese bond yields are low. So for decades, multiple decades, the Japanese yen has been at like close to 0% interest rates. And so Japanese citizens and like a lot of global institutional investors would do this thing called the yen carry trade, where they'd borrow yen bonds cheaply, sell them, convert them to cash, say US currency, and then buy US stocks. And the carrying cost, it's really like kind of like global institutional infinite banking, right? They're using cheap leverage, which has been dependable for decades, but it's not tied to whole life. It's tied to asset prices. And they went to go buy other assets. But now things are unwinding. If we look at another article from Barron's, the top here, it's what to know about the Japanese yen carry trade that is blowing up markets. And if we just scroll down, you can see this chart of the US dollar to the Japanese yen. And this is just a short-term chart. So just as of a few weeks ago, you could get 160 some yen for $1 US. But Japanese central bankers have come out with a hawkish tone, meaning they're going to raise interest rates finally after decades of this pattern. And that is strengthening the yen against the US dollar. And so now you can only get 140 yen. And so there's this whole massive flood of cheap liquidity that is now trying to unwind itself as the cost to carry that is going up, plus asset values are falling, and everybody's trying to beat each other to the door. Hence, what we see here with this massive overnight drop that was in the 5% range. And even though it bounced, we're starting to fall back again. It may not be over. So this is not investment advice. I don't have a crystal ball. But what I did read is that the shorts on this Japanese yen trade has not even, it's not even close to being covered. So there's more of these to come as everybody is trying to beat each other out the door. Now, all of this may cause the Fed to finally pivot. And I don't know if you remember, but in January 2023, I put out this video, which I'm going to link below, about what happens when the Fed pivots. And if you look at this chart, I have an updated version, but essentially every time, this is interest rates down here, right? And this is the stock market. You would think when interest rates get lower, the stock market will go up, and it does eventually. But a lot of time when the Fed pivots, it's kind of a little too late, or it spooks the market. So things go down further, as you can see here. I do have an updated version of this. I found this article on investing.com. Does Fed pivot mean it's time to buy stocks? Further down in this article, this chart, and this says real investment advice at somebody's company, but this is not investment advice. But as you can see, the S&P is here in red, the 2-year treasuries in blue, the Fed funds rate, which is like very short-term rates, what banks can borrow or lend to each other at, or borrow from the Fed window, get cheap liquidity essentially. You can see things were very high in these gray bars. These gray bars are recessions. So things are very high, and you can see there's a drop. You can see things are very high at the beginning of this, and then there's a drop. Even after the Fed pivots, it keeps dropping. And this pattern just keeps happening. So the Fed pivots, things drop, and then they rise. The Fed pivots, things drop, and they keep dropping for a long time. The Fed pivots, this is 2008, they drop. By then, the damages have been done. COVID, same thing. And here we are now. So, well, not now, this is like 2022, but just because the Fed pivots, it doesn't mean that that is a great necessarily long-term fix for asset value. So why am I saying all this? One, you have to protect yourself and position yourself accordingly. Hopefully you do have a cash hoard like Warren. If not, you may want to consider building one. And remember that if you put money in high yield savings, a 5% interest rate equals really like 3, 4, maybe 2.5, depending on what tax bracket you're in. And so that advocates the use of whole life as your own private bank, because you can get actually comparable yields over time, but without the tax hit. And sometimes you can get some very nice arbitrage with the ability to borrow against that internally. Now, going back to the taxes and why that's so important. So if we look at the US national debt, this was also big news last week. We crossed into 35 trillion, right? 35 trillion. When I made this video, we were at 31 trillion. That was January 23. So we're talking a year and a half later, a little more, we're at 35 trillion. And part of the reason is the interest on that national debt is 910 billion, almost as much as we're spending on defense and war. And so the interest on this debt is so much that it accounts for 39%. In fact, if I just put 39% interest expense on national debt, there's a study that just came out. Here's the good old AI overview. In fiscal year 2023, the U.S. federal government net interest spending increased by 39% from the previous year, from $475 billion to $659 billion. That's in 2023. We just saw how we're in 900. So this is just like exponentially getting worse. The Committee for a Responsible Federal Budget estimates that 39 cents of every dollar paid in individual income taxes in 2024 went towards paying down the interest on debt. And so this is only going to get worse. And so you need to protect yourself not only from market losses, but you need to protect yourself from the threat of future higher taxes. And yes, we have an election coming, but this has already happened. Yes, depending on who gets elected, this could get a lot worse, but this is already happening. And this, as you can see up here, it's a real-time running total. It's getting worse. So with that, I hope this helps. I'm going to be putting out some more videos in terms of what this means, moves I'm making individually, but just wanted to make you aware that we are in the realm of volatility, and it's time to put some attention towards your own positioning of assets and do some smart things. Hope this helps. We'll talk to you soon.